higher through the month of February. And I want to show you a few charts to explain why I have that opinion and how it's going to affect currencies, the US dollar, the euro, and so forth. We're going to start with this chart right here. It's the S&P 500 E-mini futures, and it's just the S&P 500 index, but I'm measuring the historical volatility, the change in the range of prices. Big candles, small candles. There is a very specific correlation between that historical volatility and the direction of prices. When the S&P 500 prices downtrend, volatility tends to increase. And when the prices are going up, volatility tends to decrease. So if you see a change in the volatility, you can anticipate that there may be a change in prices or the price trends coming up. And in fact, I think we are seeing that kind of evidence. Let's look here and notice the average true range. That's what I've got down below, and I've got a moving average on the average true range. This is the 10-day average true range with a 5-day moving average. So the blue line is probably what you want to pay closest attention to in this. But notice how we've been downward trending with the S&P 500 for the better part of a year, and the volatility, the size of the candles, tends to be highest when the chart, the price chart, is at the lowest. So let me draw your attention to a couple of key points on the chart. Right here, when we see the prices at their lowest in the month of June, then we can also see that the prices are, or the historical volatility is close to the top. But just a little bit later in August, when prices are reaching upwards, trending upwards, then the volatility is low. Now, pay close attention here. As you see in this area, the price starts to turn just as it hits the 200-day moving average. That's the big black line there. See how price starts to change from a short-term upward trend into a downward trend. And notice that right there, the volatility is giving you a little bit of a signal. See how the historical volatility, the average true range, is crossing up from below, crossing its 5-day moving average right at that point when prices start coming down. And then, of course, it continues to do that, giving the idea that, hey, that trend could likely continue, right? Now, notice the difference between that and where we are right now. This is very important because a couple of things have happened. First, you've got prices having come up above the 200-day moving average. They struggled to get up there for a little while back in December, but now they've crossed over and are kind of staying above the 200-day moving average. And as they do, this whole time they're going up, notice that the average true range is not crossing back above its 5-day moving average, meaning we aren't seeing some sort of signal that, hey, maybe this is a short-term top. And it's possible. We're price-wise, we're right at a place where resistance happened before. It might be that sellers are going to enter into the market and push this down to a new low. But if they don't, what does that say for the rest of the month of February? Likely a continuing upward trend. Seasonally, February's in the pre-election year have been a bullish month. So very good chance that we could see that. All right, well now, at the same time the price ranges are changing to be, smaller and smaller, less volatile. Notice what's happening in the options market. The VIX hit a new low in early December, but just recently now has broken that low and extending this downward trend of option pricing. The volatility in option pricing is decreasing, and that's very coincident with a bullish turn. So we're seeing a big bear market that has happened and held over the past year may be ending and about to turn up. It's kind of strange, a lot of people feel like, oh, the economy is not out of the woods yet. Well, the stock market might be predicting that within the next 6 months it could be out of the woods, the U.S. economy, that is. And the VIX going down like that, if you were to flip the VIX upside down so that it goes along side by side the S&P 500, this is the chart you might get. The orange line is SVIX. It's an ETF which actually flips the VIX. And look at what's been going on with this. This thing is just on a tear, higher and higher. And it's the S&P 500 sort of moving upwards, but this is really moving up, sort of anticipating the fact that U.S. stocks may continue to sort of break out of this and move into an upward trend. And that may not be a small upward trend. It might be a very strong upward trend. That's what that orange line, SVIX, is predicting. Now, why is all of this happening right now? What would make the turn? And the answer is that the market doesn't expect interest rates, the U.S. Fed, and raising its rates to have a major impact on the U.S. dollar or on the U.S. economy. That's the bottom line. Why do we know that? Because if you compare the U.S. dollar and the 10-year note, this is what you get. The dollar are the candles, and the 10-year note is the green line. Notice that the dollar is falling and falling. They both sort of made a turn at the same time, but the dollar kept going down while interest rates did not. So the dollar is falling not because interest rates have stopped rising. See, if interest rates go up, you would expect the dollar to go up because more people want the increased interest rate. And if the interest rates stop, well, then the dollar stops. But the dollar didn't just stop. It actually made a turn and is very seriously downtrending now for the past 3 months. And meanwhile, interest rates have sort of held. So what does that mean? Well, that means that the currency markets are anticipating that the U.S. dollar won't have more and more and more interest rate coming to it over the next several months and over the coming year. So investors aren't plowing more money into the dollar because they feel, hey, we've already sort of topped out whatever benefit we're going to get. And what that means is that the euro, because the euro is sort of on the other side of the dollar, or at least 60% wise, is if the dollar's coming down, the euro is going up. And you can see that same sort of thing here. Here's the S&P 500 and the euro, and they typically tend together. It's sort of a loose correlation, a loose tether, but they tend to move together. And yet here you've got the S&P 500 doing what it's done recently, sort of hanging around in this range that looks a little more bullish than bearish, but the euro is on a tear, running way up ahead. This is similar to what we were seeing in the inverted VIX, right? So you've got option players and you've got currency players at institutional levels, both running ahead of the U.S. stock market and the dollar, suggesting that there could be a continuing upward trend. Thus, why I believe we could see both U.S. Markets and the euro remain in a bullish trend throughout the month of February. Just my read. Hope that's useful to you. Great seeing you guys again. Take care.